Welcome, everybody. This is Jim Bell, founder and president of Bell Investment Advisors, and I'm joined today by Corinne Solera, our portfolio manager and investment advisor here at Bell. We're going to cover today a review of 2016 and a look forward to 2017. If you're having any technical difficulties, you can call that 800 number on the bottom of the screen there, 1-800-700-0089, and we'll try to help you. Also, you do have a question box where you can submit questions as we go through this. We may not have time to deal with them, but if we do, we will. And if we don't, someone will definitely get back to you to answer your question. So this is what we're going to cover today in this overview. I'll let you look that over, and I'm going to make a comment instead of reading it. Obviously, much of what we're going to talk about, or what's a big driver of events today, is the presidential election, which certainly caused strong emotions on both sides. Just to be clear, our role is to plan and manage wealth. So our job is to interpret what the actions and statements are causing that can help us grow your money or protect your money. So we're not a political organization. We're not a policy organization. We sit on the 50-yard line and just do our best to assess what are the opportunities and threats regarding your finances and act accordingly. Certainly, in anticipation and the lead up to the inauguration on Friday, the Trump statements and potential policies have created a great deal of business confidence, and we'll talk about that in some detail, but it's a very business-friendly prospect with the government now being unified under the Republican Party with the White House, the Senate, and House of Representatives. So we're neutral on the politics. We just look for the best opportunities to help you build wealth. So we're going to start by looking at the calendar, and I wanted to not just look at 2016, I wanted to take it back to December 15 of 2015. As you may recall, that was when our Federal Reserve raised interest rates 1/4 of a point for the first time in almost a decade. And they did it for the best of reasons, because our economy has been getting stronger, and so it's a welcome event to have that vote of confidence. They also predicted that they could or would raise rates in 2016 4 more times. That didn't come to pass, as we will discuss. And my personal view is that the Fed should not make these kind of predictions. They should stay data-driven, as they also assert. And the predictions erode their credibility, and they should stay data-driven. Predictions are a contradiction to being data-driven. So Corinne, what's next?
Yeah, thanks, Jim. Happy to be joining you here today. Next up is January 8th, 2016. This marks the 5th trading day of the year. What's interesting about this day is that through January 8th, the Dow, also known as the Dow Jones Industrial Average, had fallen 1,000 points in what was the worst ever 5-day start to a year. If you can recall what the headlines were during this time, there were concerns over a slowdown in China, and also oil had plummeted to a multi-year low.
Great, thank you. So This trend that Corinne is describing with the sort of meltdown over fears about China and oil, it hit its bottom, or the low for the year, on February 11th, when the U.S. stock market and U.S. crude oil both hit their lows for the period, indicating a strong correlation between the oil market and the U.S. stock market.
On March 17th, the Dow turned positive for the year, for 2016, that is. We think this is an interesting date as it shows the resilience of the U.S. market, in that the Dow was down 10% and recovered before the end of the first quarter 2016. That said, foreign markets were still down year to date and had yet to recover.
And further on in March, on the 29th, Janet Yellen, our Federal Reserve Board chair, made a statement that all of the global uncertainty justifies a slower path of the rate increases. So she was walking back the prediction, and that's what played out. As you will see, there were not 4 increases in 2016. There was only 1, and that didn't happen until December.
Mm-hmm. In June, the UK voted to leave the European Union. This was also known as Brexit. This was the first unexpected election outcome of the year, with polls certainly suggesting that the UK would vote to remain. The markets were down the 2 days following the vote, but recovered within the week. We will show you a chart indicating and showing you this recovery. But if one were to have timed out of the market this time, it would have been certainly detrimental to your performance and your portfolio.
As a further sign of the U.S. market resilience, by July 12th, the Dow recorded its first record high for the year, and this was a new high that exceeded the high in 2015 back in May. So this was when the Dow Jones Industrials crossed over the 18,000 mark.
On November 8th, as all of you are aware, Donald Trump was elected our next president. This was the second unexpected election result of the year, with again polls certainly favoring Hillary Clinton. And also it appeared that the markets were favoring her as well. Anytime she took a hit in terms of further investigations into her emails, the market also appeared to be weak. Since then, as we've seen, the market has actually rallied since Donald Trump was elected president due to what we consider his business-friendly policies, which we will discuss more in detail shortly.
And finally, on December 14th, just last month, the Fed did raise interest rates again, 1/4 point for the first time in 2016. And again, it was for the best of reasons, validating the strength and growth of the U.S. economy, and that more normalized interest rates are certainly appropriate in that context.
What this chart is looking at is the 2 key votes that we discussed a bit in the prior slides. The blue line on this graph tracked the performance of the MSCI, which stands for the Morgan Stanley Capital International UK Index, 45 days prior to the Brexit vote and 21 days following that vote. Similarly, the orange line shows the performance of the MSCI US Index 45 days prior to the US election and the 21 days following. As you can see here, both did have minor losses before the key vote, but ultimately recovered those losses and continued to gain post-election, post-vote. So our point here is that timing out of the market before either vote or really upon learning the news would have been detrimental to returns, and certainly in our opinion not justified.
Thanks, Corinne. As you may know, the bull market started in March of 2009 when the markets hit its low from the Great Recession. So that means that this bull market is about to enter its 8th year of an expansion in a bull market, and there's been lots of discussion about that. People are often afraid to invest in a market that's been positive for this length of time. We want to make the point here that just because we're entering the 8th year doesn't mean it's more likely to end than an expansion that's maybe only 2 years old. That's just the way that the probability works. And in this situation, you have the unexpected election of Trump, which is it's a real game changer for the present and future. And it introduces a whole new set of variables which were not predicted or expected. So these events can occur to extend a bull market much longer than people might expect. What usually kills bull markets are things such as a misguided central bank policy. In this case, it could be keeping interest rates too low too long, or raising them too much too fast. Financial bubbles that pop certainly will destroy a bull market or stop it. And a third possibility is a shock from overseas, and the turmoil that President-elect Trump is stirring up with China, for example, could represent some such event. It's unknown and hard to predict. Further on this, as we enter the 8th year, we had a 10-year bull market expansion that began in 1991. In Britain, there was a 17-year expansion bull market that started in the early 1990s. And in the Netherlands, an expansion bull market went for 26 years before ending in 2008. And there's an expansion bull market taking place in Australia that's still going, and it's 26 plus years old. So our point is that, just because a market's reaching all-time highs and it's been proceeding for some time, doesn't mean that the process is going to end.
Thanks, Jim. We had an additional thought about age. Jim saw this quote in a recent Economist article, and we thought it was fitting. So the quote is, "Age is plainly no barrier to managing money." And what you see below the quote are a few examples of prominent investors and their respective ages, with Warren Buffett, his age is 87, Pickens at age 89, George Soros, age 87, Carl Icahn, age 81. One note on George Soros. He became more defensive, bearish upon the election results in the U.S. Some of you may have seen that. And he did lose nearly $1 billion. Again, just a cautionary tale. Even those considered experts in the financial world can incorrectly time the market.
Thank you. So getting into what are referred to as business-friendly policies that are being debated at this point. Here's three of them that we've identified certainly as strong policies to build business confidence. The first statement here is that monetary policy may actually get help from fiscal policy in the current situation, And we thought this was a good opportunity to just remind people of what the differences are between monetary and fiscal policies. So on the monetary front, monetary policy refers to decisions made by the U.S. Federal Reserve Bank to control interest rates and money supply. On the fiscal side, this refers to decisions made by the U.S. Congress and the President regarding taxes and government spending. These two policies are meant to work together. That hasn't occurred in the past 8 years or so due to the gridlock in Congress. So the monetary policy on the Federal Reserve side had to carry all the weight and do the heavy lifting. Now there's this prospect that they can actually work together. So the three areas that we're focusing on that are causing this business confidence is the potential for corporate and even personal tax reform. The Trump administration is certainly in favor of rolling back regulations, whether you like that or not. It is something that the business community favors to be less restrictive. And finally, the possibilities of large infrastructure and defense spending programs can certainly help the economy.
So the sectors of the market that have benefited from the expectation or anticipation of the policies Jim just moved us through, and others from the incoming administration include banks and the financial sector as a whole, due to those regulatory rollbacks Jim referenced. Banks also are getting or received assistance from the Fed recently with their first rate hike of 2016 back in December. Industrial stocks also are benefiting from the expectation for increased infrastructure spending and that increased need for both raw materials and machinery. And then finally, small cap companies, which are companies that have less than $2 billion in market cap. So the two reasons that we see or believe that small caps have done well since or post U.S. election is one, the anti-trade sentiment or rhetoric we're hearing from the Trump administration, which could likely mean that more money is being spent domestically. And also the strong dollar, which Jim will detail further later in the presentation. But a stronger dollar benefits smaller companies over larger ones.
Thanks, Corinne. So Corinne mentioned the favorable situation in the banking sector right now. And I thought this chart would be instructive. I wanted to show this just to show the kind of historical correlation between the banking sector and the U.S. Stock market in general. It certainly is the case that when bank stocks rally, it validates and helps the rally in the overall stock market. It's pretty important to have the banks support and participate in any stock market rallies that have some substance.
So all that said, what could go wrong? Well, first, we believe that the expectations for Trump and his perceived business-friendly policies are very high. We believe that pushback is possible even with a Republican-controlled House and Senate. And even if he doesn't receive any pushback, policy implementation will still take time. And it seems at this point the market is looking for immediate results. I probably don't need to say this, but it seems Trump loves to be both unpredictable and that he relishes surprises. He's called out individual companies before, as well as countries. And this is interesting since generally the Republican principle is that government shouldn't tell businesses what to do. But Trump certainly seems to be going a different direction there. The final point here is that financial markets generally do not like, they don't like to be blindsided, and they also don't like unpredictability, which is certainly something we're seeing currently with our president-elect.
So some further problems, which certainly could arise, is there are at least 75 pending lawsuits against Trump, and as these proceed through the court system, since they were filed when he was a private citizen and not the President of the United States, this is going to shine a big spotlight on his business conflicts of interest and his role as president. The second point here is that Trump has certainly alienated all of our major trading partners. Seems like almost every country's been insulted, save Russia. So this kind of saber rattling could certainly blow up in our face. Again, The Economist magazine predicts that cost of living for United States residents could go up 40 to 60% if all of our trade policies were completely turned upside down. So that's a concern. And the final point here is whether or not Trump will listen to any experts. In some ways, his cabinet seems to toe a more traditional and predictable line of thinking. Finally, before we get into other issues, the U.S. population is not growing as fast as it was. As a matter of fact, it grew only by 0.7% in the last annual period. And that's the lowest population growth that we've seen since the 1930s, which is a pretty scary reference point. This has been caused by an uptick in deaths, a slowdown in births. The Great Recession caused a drop in the number of babies, and it hasn't changed. There has been no recovery in that. And the third point is that there is a drop in immigration. Ironically, one way to solve this problem is to have a reasonable, robust immigration policy. It's pretty well known that immigrant families have more children than the U.S. residents that are already here. So our labor force is not growing, or it's not growing fast enough to produce a robust economic growth. Baby boomers are retiring and leaving the labor force, and then we have this problem with the birth rate. So that is a concern.
Thanks, Jim. So we've talked a good amount about the stock market so far in response to the U.S. election results, and we'd be remiss if we did not address the moves in the bond market since the election. Since the election through December 18th, per the graph below, the largest 500 companies in the U.S. have added $1.13 trillion in value, while the U.S. Treasuries alone lost $707 million during that same time period. So why did that happen? Well, we saw flows out of bonds and into stocks. Probably folks trying to catch the wave in terms of that rise in equity prices. Also, we saw interest rate moves with the expectation of higher growth and an inflationary environment due to Trump's policies. So this next slide is a chart of the 10-year Treasury note yield for 2 years, so January 20th, 2015 through yesterday's close, January 17th. As many of you know, bond prices move in the opposite direction of interest rates. So what you see here is I'm going to highlight what happened just in the year 2016. In January 2016, the 10-year yield was at 2.25. And as you can see here, December 2016, it ended the year at 2.45. So really that alone was not a dramatic jump or leap. It really was what happened within the green oval that you see in your screen. That was a dramatic rise in interest rates from the day of the election to year end. This really put price pressure on bonds, especially long-term bonds. Those were hit the hardest. We take a diversified approach here at Bell to our fixed income exposure, and we've been emphasizing short-term to intermediate-term bond funds for years. And this exposure or this lean certainly lessened the blow, if you will, during this time period from the election to year-end 2016. We're pleased to see that rates have stabilized some year-to-date 2017. Currently, again through yesterday, the yield for the 10-year ended at 2.33, which is certainly helping fixed income. Final note on this slide, and in terms of bonds, folks are asking us, but what if rates continue to rise? We think the historical period of 1976 to 1981 is a great reference point. During this 5-year stretch, the 10-year Treasury yield rose 9% from 6.8% to 15.8%. And during this period, you may be surprised to hear that short and intermediate term bond funds still made money. So really, if bonds and fixed income are supported by your financial plan, or you don't have the risk tolerance to invest in the stock market, we certainly think that bonds are still a great investment and a good place to be.
Thanks, Corinne. So certainly looking at the strength of the U.S. dollar has some significant consequences. The dollar grew in value by 3.6% in 2016 and 4.6% gain in the fourth quarter of 2016. The strong dollar is not good for multinational companies that concentrate on selling their goods and services overseas. Those goods and services become more expensive. On the other hand, small companies that sell to the domestic market often import materials or even services from overseas, and with the strong dollar, they can purchase those goods and services at a lower rate. So that will help the importers, but it's going to be bad for export. And we're keeping a close eye on this, with the United States being really the only major developed country that's raising interest rates. This causes demand for U.S. dollar denominated bonds and stocks, and we're benefiting from that in terms of which way the rally goes.
The gross domestic product, also known as GDP, grew at a rate of 3.5% in the third quarter of 2016. This is the fastest pace the GDP figure has grown after 3 quarters of sub 2% growth.
So just a final few points. We've talked about what could possibly go wrong. There's a lot working in the favor of the United States right now. First of all, the long period of economic growth, and optimism is high. Home values have regained much of their value, so that creates a wealth effect for American families to feel more confident. The hiring continues, especially in small business, and consumer confidence is at a 13-year high. So all this contributes to a promising present and future. As I said before, the increasing interest rates just validates economic strength in the United States and the expectation that that'll continue. Lighter regulation, as I mentioned as well, is looked on very favorably by the business world, and household income is rising at the fastest rate since 1964. So these are considerable positive elements to the current situation. In conclusion, we've demonstrated how certainly in 2016 market timing did not work. And our point here is that your investment strategy should be well grounded in a financial plan that relates to your circumstances and goals. And when that's the case, it should not be changed because of politics or emotional reactions. And what we do here at Bell is focus on data to make our choices about where to allocate. We're not predictors of the future. We do analyze trends that we think will continue, but we always look at what is the current data showing. So we do have one question. What does all of this mean for Bell's strategy going forward in 2017? In answer to that question, the sectors that we identified is certainly something that's working for us. The rally in bank stocks, the rally in industrial stocks, and the rally in small companies is something we'll continue to emphasize. Energy is part of that as well. Mm-hmm. So in looking at the data, we'll continue to ride those trends, so to speak, until they change, and that's what we're watching for. Do you have anything to add to that, Corinne?
No, I think that's perfect, spot on. I think the last point, focus on data, not predictions, is going to continue to govern our strategy in 2017.
Thank you. So we appreciate you spending this time with us. We always like to hear from you. We welcome your calls and messages. So here's some of the ways that you can be in contact with us. We have recorded this session today. It will be posted on our website in our library in about a week. If you'd like a copy of the slides that we went through today, we can also send that to you separately. So just let us know and we can email those to you. And as I said, there's lots of ways to interact with us, and we hope you'll take us up on that and join us for future webinars. For our clients, we're going to be doing an investment committee update on February 23rd. That's for clients only, but we'll be reminding you about that as we go on. So thanks, Corinne, for working on this with me.
Thank you.
Thank you all for joining us.